So we spent a lot of time talking about financial relationships that are prohibited, but there are other types of things that can be problematic too. So there are prohibited business relationships, and we have family relationships on the next slide. So let's talk about the business relationships first. This can cause major issues if a member of a client's management team or somebody working in a key position winds up going to work for the audit firm, or vice versa. And this is actually the most common case, is somebody in the audit firm or in the audit team goes and works for a client that they formerly audited. All right, so what needs to happen here? There's a few things in place that try to ensure that there are no independence violations. So one thing, which is actually, this is a public company rule, it says if you leave the auditor and go work for the client, you have to have at least a 1-year cooling off period. So you can't go into that managerial role until that year has passed. Generally, for private firms, they more so want to make sure that you're not auditing the same fiscal year that you're also in a managerial role for. So you don't necessarily have to have a 1-year cooling off period, but you can't have overlap within the same fiscal year. There's also other requirements you have to meet. So you have to make sure, for instance, that you've sold off all your shares or in the former company or former audit firm's 401k plan. So they'll have other rules like that to try to ensure that you're really financially independent from your ex-employer. Also, if it's the auditor going to work for the client, there's other things we do to try to make sure that the audit is unpredictable, right? Because one of the risks here is you know all the secrets of the audit, you know the materiality thresholds, you know all the procedures we do to try to catch fraud because you're on the audit team. And then you go work for the client in a managerial role, you could potentially be in a very good position to help them conceal fraud. So we want to make sure, as the remaining audit team still in place, that we try to make the audit more unpredictable, try to come up with new procedures and new approaches. Don't just follow the same old approach that the person who now works at our client knows everything about. So now we have family relationships, which can also cause independence issues. So a covered member's immediate family, which would be their spouse and their dependents, are also subject to the independence rule and interpretations, meaning the immediate family are basically also covered people in that they need to follow all these independence rules. So if I'm the auditor for Coca-Cola, my husband cannot own shares in Coca-Cola. These types of things make sense. There's considered to be 2 situations with close relatives, so not immediate family, but close relatives, that can impair independence. So these close relatives can include non-dependent children, siblings, parents. Oh, and one thing to note is your textbook also lists these 3, grandparents, parents-in-law, and their spouses, as close relatives. But if you actually read the AICPA code of conduct, these 3 parties are no longer included as close relatives. So if you get that on a test question, you know these aren't included anymore. All right, so there are these 2 situations with close relatives that can impair independence. One is if the close relative has significant financial interest in the entity, it's material to them, and you are aware of it. So if you're not aware of it, yeah, you can plead ignorance, but for the most part, you should be aware or try to make yourself aware if your close relative has any important financial connections to the client. All right, so this can also be an issue if, for somebody in the engagement, right, a covered member, if they have a close relative who could exercise significant influence over the client's financial or accounting policies. And this is usually called a key position at the company being audited. So if you have a close relative in a key position, then this could impair your independence. Actual or threatened litigation can also impair independence. So this could be both ways, right? It could be the CPA commencing litigation against management, saying they're committing fraud. This could also be management starting litigation against the auditor, saying you have poor quality work. And again, the idea is if you have a lawsuit at stake, this causes your relationship with management to become one of conflict rather than, a good working relationship where we can share information and so forth, because it's going to severely impair your ability to audit a company if management of that company believes you are the enemy and they don't want to give you any information, right? So this is kind of our common sense that, hey, if there's litigation or if they start threatening litigation anytime, we ask for evidence and they don't want to provide it, this can cause a conflict. Providing non-attest services to attest clients can be an independence violation. Right? And this part of the rule is a little bit different for private versus public companies. So the code of conduct, which remember applies to everybody, says you can provide some of these non-attest services. So you can provide bookkeeping, systems implementation, etc., to your non-public attest audit clients, as long as you are subject to certain conditions. And if you read through the conditions, there'll be things like, hey, you can try to implement the software, but you can't design the system. And another thing, which is down here, also tends to say, hey, you can provide a lot of these professional services, but you need to manage threats to your independence, meaning you're supposed to step back and make sure you can still be objective and provide these two services. Now, you officially can't perform appraisal, evaluation, or actuarial services if those services have a material impact on the financial statements and are highly subjective. So these services tend to be highly subjective by nature, but this is where materiality comes into play. If it's an extremely small acquisition, yeah, maybe they can help you out. But if it's a large one, then it starts to violate independence. Basically because the fees will be impacted by that, right? If it's an immaterial acquisition, then probably the fees they're providing to you are also going to be immaterial, right? But if it's a huge acquisition they're doing, then the fees related to like valuation services for that will also be very high, and they'll start to become material to the overall fee. This is for private companies, right? So private companies actually, it is pretty permissive. It still allows you to do a lot of these services as long as you're managing threats to your independence, as long as some of the fees aren't material, etc. But the SEC has much more restrictive rules for audits of public companies. And these were part of SOX. And so the main idea behind these additional, more restrictive rules from SOX is we want to make sure that three basic principles are being followed. So one is an auditor should never be auditing his or her own work. And so you can see where something like bookkeeping services, you could wind up kind of installing a company's bookkeeping or general ledger system, which tracks all their journal entries. And then you come back as the auditor and you were auditing those same journal entries, right? You are grading your own work then. And we all know that whenever somebody grades their own work, they're most likely to give themselves a 100 or an A grade, right? It's very difficult to be objective when you're looking at your own work. The next principle is that auditors shouldn't be functioning in the role of management. It means, hey, if you're working in a key managerial role, as part of that role, you're coming up with the accounting principles that the company has to follow, and you're figuring out how to calculate various estimates, then you shouldn't also work as the auditor, because auditors audit the work of management. And then if you are both auditor and serving in a managerial role, you will effectively end up auditing your own work at some point or another. 3 is that the auditor shouldn't serve in an advocacy role for the entity. So think legal advocacy here. So like an auditor shouldn't be an expert witness on behalf of their clients. And this is kind of gets into independence in mind as well as independence in fact, because if you serve as a legal advocate for your clients, you're testifying on their behalf about how what they're doing in terms of the financial accounting principles and policies that they follow. If you're testifying that all those things are correct and good, then when you come over here later and start to try to do your audit, you're going to be influenced by your earlier work as an advocate, right? So it basically causes issues with the auditor's objectivity. And the SEC tells us 9 categories of services which are considered to impair independence, right? And they're listed out here. One thing that's interesting is that the first 8 were actually prohibited pre-SOX, and really the 9th, expert services, was added post-SOX. And basically the thought was these are relatively specific. And so the auditor figured, hey, I'm doing work for the client, but it doesn't specifically fall into these 8, then that's okay. And SOX came back and was like, no, it's not okay. You really shouldn't be providing any of these outside services, like things like consulting to your client. And so let's cut all this off so that you're just providing the audit services. So part of the reason why SOX forbid this is because for many clients, including Enron, the fees being paid out to auditors for expert services could be close or even in excess to their audit fees. And I have a quick little video clip for you to watch, which I will link separately in the activities for this chapter. So make sure you check that out. It'll just kind of help reinforce some of these things we're learning today. So some additional rules required by the SEC PCAOB are that lead and review partners can only work on an engagement for 5 consecutive years at a time. They can come back eventually and work on it later after 5 years off the client. Right. So again, we talked about this before, that we do have partner rotation. And this again was coming to us from Sarbanes-Oxley. So you used to be able to be pre-SOX, be the partner for however long you wanted to. So this is a SOX requirement, but we don't currently require in the US that the whole firm rotate. And we already talked about this, that you can't go work at the client unless this 1-year cooling off period has passed. And if the audit partner's comp is based on selling services outside of audit or outside of a test to the client, so stuff like expert services, then it makes the partner not be objective, basically. So their objective and their best interest really is to sell the most services possible, not to provide a fair opinion on the financial statement.